Ladies and gentlemen, good day and welcome to the Tata Chemicals Q4 FY21 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Gavin Desa from CDR India. Thank you, and over to you, sir.
Thank you, Margaret. Good day, everyone, and thank you for joining us on Tata Chemicals Q4 and FY21 earnings conference call. We have with us today Mr. R. Mukundan, the Managing Director and CEO, Mr. Zarir Langrana, Executive Director, and Mr. Nandakumar Tirumalai, the Chief Financial Officer. Before we begin, I would like to mention that some statements made in today's discussions may be forward-looking in nature and may involve risks and uncertainties. A detailed statement in this regard is available in the result presentation. I now invite Mr. Mukundan to begin proceedings of the call. Over to you.
Thank you, Gavin, and good morning to everyone, and welcome to our Q4 and FY21 earnings call. I hope all of you are safe and sound and healthy. Before I start, let me introduce my colleague, Zarir Langrana, Executive Director, and Nandakumar, who is our new CFO, who took over from John from 1st April 2021. Before getting into operations, I just want to say that we are all working very hard to keep our employees safe as well as our community safe during the second surge. A lot of work is going on in terms of our effort towards contributing towards handling this crisis. And this effort is not just centered in Mithapur, where our operational largest plants are, or in Gujarat and Dahej or Ankleshwar, where Rallis units are, but also right across where our big clustering of our teams are. So they're all working hard to make sure that we overcome this current crisis. Operationally, I must say that this quarter, when you look at overall volumes, market side data has been positive, but financial outcome has been fairly muted and has been fairly sharp reduction in the financial outcome in terms of profits, you would have noticed. We'll walk through that. Let me start with firstly the volumes are completely back. The TCNA export volumes have picked up nicely and are back to the normal run rate, and that's a big positive, and we would continue to see that run rate go through right through the next year. In terms of demand across sectors, all of them are showing positive trend. And I'll speak with one exception, maybe some kind of a delay or movement by 10-15 days in terms of de-inventorization may be happening in India because of this current COVID situation. But otherwise, overall, we think the volumes are going to continue to be strong going forward in the current year. And that was reflected in Q4. What did happen in Q4 was very specific to several one-offs, which we'll speak about as we move forward. The second element during the year has been an extremely tight focus on cash flows and operational cash flow, and the teams have done well. I think India has actually delivered negative working capital for the first time, a very creditable performance. At the same had, even with lower profits overall, much higher operational cash flows right through the year, both at standalone and consolidated level. And Mr. Nandakumar will walk you through that when he comes on and presents the financials of the company. The demand from sectors, detergent and container, the glass segment, all are back. Container glass is slightly soft right now, but we expect that it would pick up. In terms of margin, we did have, as we had alluded to, TCNA exports. There's been a price reduction of $5, but sequentially we expect the prices to move up in line with spot. Spot prices have actually had a very strong bounce back, in some cases expanding as much as by $25. So every quarter as the spot quantities which we have in the market would then get reset to the market prices, and we would see the complete reset by the time we come to Q4 of this year on the contracted quantities. As far as US is concerned, we had one-off coming from the event which happened in polar vortex, which froze the oil wells in Texas, from where the gas feed happens to our unit, and that resulted in approximately a one-time hit of 45 crores. And we are re-looking at our hedging policies to make sure that these sort of price spikes which happen do not impact the company going forward. The prices actually spiked up from $2.30, which is a normal range for MMBTU, to right up to $150, $160 per MMBTU during that period of presidential holiday, which was a 4-day weekend. In terms of UK, while the business was steady, there was a bit of softness in UK in terms of the salt sales, mainly arising out of the very, very strict shutdown orders which UK had done in the quarter one of the calendar year. As UK opens up post its corona cases coming down, I think this softness should start to come down. Otherwise, UK is also fully sold out, and we would continue to see good outcomes from there. However, we had two one-offs in UK. One was refinancing cost for the quarter. There was also a tax asset write-off which we had to take this quarter, and there was an impact of unseasonal floods which impacted the operations in a minor way for a small period of time. In Magadi, while the realizations were lower, the margins did contract. The team did a very creditable job of ensuring the fixed costs were controlled, and they ended up delivering a profitable outcome as far as the final numbers were concerned. So very creditable performance by the team in terms of making sure they were profitable. So overall, as you see, the operations in India, both Tata Chemicals and Rallis are profitable, and Magadi delivered profit, and there were one-offs in UK and USA which impacted our final number. In terms of the new businesses, other than in what is in Mithapur, the Cuddalore unit is doing well, and they are going to continue to work towards moving their product mix towards the rubber and tire industry. And the Nellore unit, in fact, has also done well and would continue to improve the utilization going forward. And in terms of the salt sales, there have been an encouraging growth, and it continues to grow. And we believe that our expansion plan, which we put up in Mithapur, is on the right track, which supports the expansion of salt along with the debottlenecking of soda ash. As far as agri business is concerned, Rallis has done an excellent job, delivered a very, very encouraging quarter, and their plans are going to be prioritizing and delivering growth in the coming years with focused investments to ensure they can enhance their product portfolio. A quick word on CapEx. Out of total committed 2,400 crore, we have earmarked approximately 400 crores for FY22 and have spent about 300 in FY21. The expansion plan both in Mithapur and Rallis is on track with some moderate delays due to COVID situation because of shortage of labor in some of the contractors. I'm happy to announce that, share with you, the board has announced a dividend of rupees 10 per share. This will be subject to shareholder approval in the AGM. To conclude, I want to reiterate that our strategy of building the performance material business beyond soda ash into silica is on track. Our nutrition business, trying to build a portfolio of products, especially based on fermentation technology, beyond salt, is on track, and our focus to offer a wide portfolio of crop protection and seeds to our agri farmers through Rallis is also on track. We believe that we will be able to overcome this surge in cases which we are all going through in the coming months, and we believe with the pace of vaccination picking up as it is expected in the coming weeks, we would slowly get through this crisis which India is facing. With this, let me hand over the floor to Nanda Kumar. And Nandu, as we know him, he's been part of the Tata Group since 2012. He was with Titan prior to joining us here as Vice President Corporate Finance and was overseeing the complete finance function in Titan, overseeing including corporate finance, business finance and subsidiaries. With this, now let me hand over the floor to my colleague Nandu, who will take you through the financial performance. Over to you, Nandu.
Yeah. Thank you, Mukund, and good morning, everyone. I will just walk you through the financial performance, after which we can start the Q&A. I have now this talk would be over 5 sections. Standalone, I'll move on to US, then to UK, Kenya, Rallis, and Conso. Standalone business part, the key highlights are the soda ash volume for the quarter at 1.84 lakh tons is 16% more than the last year's Q4. Standalone business, our revenue for the quarter has gone up from 734 crores in Q4 to 841 crores in Q4 of this year, a 15% jump over last year's Q4 in the revenues part here. The revenue in the basic industry has gone up by 13%, and of the specialty by 59%, though they have a smaller base. The other expenses for the quarter has gone up from 118 crores to 141 crores, increase compared to last year's Q4, mainly because of consumption of stores and spare parts and repairs and maintenance. This is more a timing issue as the overall other expenses for the year is almost same as the previous year. The EBITDA has moved from 140 crores to 164 crores, a 17% jump, and PBT has gone up by 11% here. There's been an increase in fixed costs in Q4, mainly because of the mentions the reason on top. But this has been offset partly by a one-off interest booked of 18 crores on income tax refund. So though the increase in fixed cost is offset by the one-off income on the interest on the income tax refund which you got in Q4. On the balance sheet and cash position for the full year, our cash generation has improved from 427 crores in FY20 to 672 crores now, a big jump, mainly because of tight working capital and capex control. Our cash position moved to 2,098 crores in March 21 compared to almost same number last year. The capital spending for the quarter was 205 against 143 crores last year, mainly in Mithapur, and the entire year capex spend is 548 crores against 694 crores last year, our 150 crores drop in the capex spend here. Our investments in the quoted shares in the group companies has gone up sharply, which is again resulting in our net worth going up. The net worth has gone up from 11,977 crores to almost 1,500 crores increase in the current year. Moving on to US, in the US business where you are seeing a sharper drop in the PBT, I talk more about that in this section now here. The soda ash volumes have improved from 5.5 lakh tons in Q4 of last year to 5.68 lakh tons, a 3% increase, led to an increase in revenue also. The cumulative drop in Q1, Q2, and Q2 was 20%, and for the first time in this year, we've seen for the quarter 4 an increase in the volumes. The PBT was adversely affected during the quarter, and the 92 crores profit made last year has gone to a 60 crores loss in this current year Q4, mainly because of the following few reasons. One is that the price recovery is not complete and still lacks the previous year net sales price. Second was in mid-February of this year, there's Arctic blast led to extreme cold weather that led to natural gas demand shooting up, and natural gas price shot up from, as Mukund mentioned earlier, almost 100 times. And we have a policy of hedging our gas, and we are able to curtail the impact because we are hedged mostly. But on the unhedged part of the gas exposures, we had a 45 crores impact on the open positions, which we believe is a one-off event. The production levels came down in the quarter, because of which, as you know, when production lacks the sales, the fixed costs are underabsorbed. We had a 40 crores impact because of the underabsorption of cost, because the production was less than sales. But this again is timing issue. Let's say next quarter production goes up, we'll have the recovery happening here. So both aspects mentioned here are one-off, we believe, for Q4. There was also a higher spend in Q4 on account of repairs and maintenance. So these 4 reasons caused the drop in the PBT in US from last year to current year. Coming to UK. In UK, the volumes in both soda ash and bicarbonate were lower than Q4 of last year, a bit lower, mainly because of the impact of flooding that happened in the UK and a bit lower demand. The revenue for the quarter was 5% more than the corresponding previous year's Q4. We had a 28 crores loss in Q4 in UK as compared to 13 crores profit in previous year, mainly because of the one-off expenses like a tax write-off and refinancing cost and floods. Moving on to Kenya, Magadi, the revenue has come down a bit compared to last year's Q4. However, because of tight cost control, the PBT has moved from a loss of 4 crores last year in Q4 to 10 crores profit in the current year, mainly because of the margin expansion during the quarter, because lower input cost, improved part efficiency, and fixed cost getting optimized. Rallis, if you look at the whole thing, the revenue has gone up by 36% in the quarter compared to last year's Q4, mainly because of crop care jump and very good international business. PBT grew from 1 crore last year to 8 crores this year because of the above growth. The last section is the Conso, considering all the previous sections, is that overall volumes grew for us in Q4 compared to previous Q4. The Conso revenue grew by 11% over last year's Q4. The EBITDA for the quarter stood at 283 crores, a fall of 30% fall compared to previous year, and PBT fell from 217 crores to 80 crores. The console capex was at 411 crores compared to 300 crores last year, and on the full year basis, the capex was half of last year. The free cash flow from operations for the year was at 450 crores, a 65% increase over the last year's full year due to efficient working capital management. The console gross debt was at 6,933 crores, down by 770 crores compared to last year. Net debt is at 214 crores, lower than last year, and standing at 3,828 crores. The console net worth has gone up from 12,898 crores to 14,490 crores, an increase of 1,400 crores in the last year. That is a brief summary of the last year's highlights. And back to Gavin.
Shall we open the floor for Q&A session, sir? Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Amanjeet Singh from Oculus Capital. Please go ahead.
Good morning, sir. Am I audible?
Yes, you are audible.
Yes. Thank you for the opportunity. Sir, in the last quarter call, with reference to electrochemistry, so you had mentioned that the board had cleared the plan, but nothing was finalized. So just wanted to check about any update or any plans have been firmed up on the lithium ion.
Let me take this question. There is no further update. The entire business is under evaluation. And if there's anything specific, we'll come back to you. As of now, as you know, our status remains the same. We've got licenses from several entities like CSIR as well as ISRO. And the R&D work will continue. But beyond that, there is no further update. And whenever there's an update, we'll come back to you.
Sure. Thank you. Sir, anything on the battery recycling, sir?
Sorry?
Anything on the battery recycling, sir? Last time you had mentioned that you are making investments in that.
That is continuing. That is continuing, and the business is being handled as part of the performance material vertical now because they've got a good sales team, and because the business is now scaling up, it is being handled under the same performance materials vertical. We will call out specifically the numbers maybe from the first quarter of next year in terms of what is the recycled sales, and it's now gone beyond lab into actual business line.
Sure. Thank you, sir. All the best.
Thank you. The next question is from the line of Rohit Nagraj from Sunidhi Securities. Please go ahead.
Yeah, thanks for the opportunity. So just taking the earlier question forward, so till a couple of quarters back, we were showing in our presentation as the fourth pillar being the energy sciences sector. But this particular presentation shows only the 3 pillars. So is there some change in terms of strategy for the lithium battery, or is it gone on back burner due to COVID-related factors or any other factors? Thank you.
So I think our view was that, in fact, we wanted to make sure that we were very accurate in our statements, and since it was being picked up as an extra item, because we had been maintaining that this is a business which is under review, we are making all the right first few steps in terms of exploring it. I think that status remains exactly the same. We didn't want to sort of pitch it beyond that, which is why we've said that we'll focus on where the revenues are, and that shift has happened after our internal review. That's about it. In terms of the exploration, I think the company would continue to explore that space because there are several opportunities in that space in terms of serving that market as India and the world transitions to new energy outcomes.
Thank you. So the second question is on the soda ash market. So have we seen any kind of new capacity additions across any geography? And what is our view in terms of pricing of soda ash across different geographies for the next maybe 6 months to 1 year? Thank you.
So I think Jerry will add more color to this, but I just want to highlight that the demand is fully back, I think, across the globe. The container glass demand is the only one which is slightly lagging now with as tourism picks up, even that would pick up across the board. And overall, there is tightness in the market because of which spot prices have moved up. And I think this situation is likely to continue for some time. And as you would know that several of the expansion announcements which were made have all been put on a pause mode, and there have been public statements made by several of the entities which had announced this because of the current pandemic, which will probably mean that any fresh announcement would take at least 3 to 4 years to fructify. Zari, do you want to add anything further to this?
No, I think that's absolutely right. I think producers who had announced earlier are probably waiting to see long-term secular trends, both in terms of demand picking up, which is very positive, as Mukund mentioned. But more importantly, I think the lagged effect of pricing, once that comes into play, you might see some of them coming back with announcements, but it will probably be at least 3 to 4 years before we see any fresh volumes coming out of these plants, which means that the market will continue to tighten.
And any just a follow-up on that, any sense on the pricing across different geographies, sir?
So as Mukund mentioned, spot prices in many of the export markets have staged a sharp comeback. In some of these markets, I think people are contracted, but as these contracts, whether it's quarterly, half-yearly, or annual, come up for renewal, I think you'll find soda ash producers, including ourselves, moving in tandem with what market pricing is. So yes, the movement is positive and upwards in most markets. India, given the current state of what's happening on the pandemic, as Mukund said, there's some de-inventorization that's taking place, and that might affect price movements maybe by a few months. But overall, demand is back, and that is always a positive sign.
Thank you so much, and best of luck, sir.
Thank you. The next question is from the line of Sumant Kumar from Motilal Oswal. Please go ahead.
Yeah, hi, sir. So my question is regarding US business. Post incorporating of 45 crore of the cost, one-off cost, still US business EBITDA is subdued. So I can understand you are hedging your energy cost. So maybe some part of is not hedged and fuel price has increased. Apart from that, any other reason for the subdued performance?
What Nandu has already explained is that there are two effects which happens when you, because of high cost of gas, we only produced to the extent we were hedged, so that we reduced the impact of the spike in the gas prices, so that led to loss of production. But our sales remained. We were selling out of our inventory. But when you de-inventorize and your costs are still continuing, you have unabsorbed fixed costs, which already Nandu has highlighted was also equal to. We can't put an exact number. But I think it's estimated to be close to another 40 odd crores. Nandu, you want to explain that?
That's correct, Mukund. See how it works, Sumant, is that whenever in a quarter we have production which is less than sales, the costs are under-absorbed. In a quarter where the production is more, it's over-absorbed. So it's more of a contra item and timing issue and not really a loss in that sense, which is a permanent loss. So, but 45 crores of natural gas is an event which has happened. We can't recover that. However, this 45 crores for 40 crores of the fixed cost and absorption is more a timing issue. Next quarter, in case the production is more than sales, you get a gain back. So, but for the quarter, we had a double whammy in terms of the gas price as well as in terms of the cost under absorption because production lagging the sales.
But when we see the performance of the previous year, 208 crore, and we subtract, say, 45 crore, the EBITDA difference is 96 crore. So going by your number, the 96 crore minus 45 crore, again, there is a gap of 45 crore. So what are the cost has increased in 45 crore? What difference will we have?
Yeah. So the balance is mainly because of the increase in the fixed cost, more because of the we had, I think, 1 week, 10 days of lockdown happening in US for the plant, and the stores and spare parts consumed were higher in Q4. This also, if you see, for the year, it's okay because in console level, the fixed costs are intact. It's more a shifting of costs from Q3 to Q4. Not really.
And also, Nandu, one more point we should add here, that which is a point you had already highlighted. There is the exports are fully back now, and the export volume, when you take it at a $5, let's say, which is what the fall in price is, that would account for the rest of the change which has been there.
So can we say the overall mix of the business has changed towards the export, because domestic sales has declined and domestic has a better margin and export has a lower margin?
Correct. See, I think that the way to look at it is that the mix is now at the level it should be with domestic and exports. Exports are fully back, and the export prices are actually low by about $5. And I think, as Zarir explained, every quarter as we get the pricing back in our, I think this would sort of start to move up again. So as the contracts are, for example, the contracts in Asia are quarterly. So as the export contracts in Asia get reset on a quarterly basis, this should get adjusted over a period of time.
This quarterly basis is going to fit in the coming quarter?
The quarterly change, I think Asian contracts of exports out of USA are quarterly contracts. So every quarter you would see them moving in tandem close to the spot prices, because that's where the market is. Zarir, you want to clarify further?
Yeah, I think that's exactly right. I think the majority of export contracts in Asia are quarterly. As they come up for renewal, you will see pricing getting reset in some of these markets as far as exports are concerned. So yes, the trend is going to be upwards as far as Asian pricing is concerned. In some of the other geographies that might, where contracts are either half yearly or annual, it might spill over into subsequent quarters.
So what I understood, overall 141 crore difference of the EBITDA compared to previous year, same quarter. And out of that 45 crore one-off and 45 crore operating the fixed cost. Then 45 crore is all because of the price, whatever the price decline in export market. And any other reason for freight cost?
So there are 4 reasons, Sumant, as explained. One is in terms of the 45 crore on the gas, and 45 is because of the fixed cost absorption, and 30-40 would be the fixed cost getting deferred from Q3 into Q4. Therefore, the Q4 expenses are higher. The 4th element is the price change. All 4 is
Hello?
There are 4 elements, Sumant, if you could hear me right. I repeat that. One is the gas price increase of 40-45 crores, that's the impact that you spoke about. 40 would be on account of the fixed cost under absorption because of lower production than sales. 3rd is the fixed cost itself going up because they moved the expenses from Q3 into Q4, but the overall fixed expenses remain intact. The 4th element is what Mukund explained on the price drop compared to last year. Last year's Q4 or this year's Q4, there was a price difference. All the 4 put together has led to this drop.
Okay. And you talked about the other expense increase because of repair and maintenance cost in standalone. Any other reason for higher other expense in console level?
No, not really. See, we look at console for the year as a whole, Sumant. I think it's almost on par with last year. It's not much of a change. Okay. So there's no other reason apart from some costs moving in from Q3 into Q4, because we can't time it exactly. The spend happens the way it's supposed to happen. So there's no other bigger reason beyond that. It's only because of the bunching up and happening.
Actually, the fixed cost internationally has gone down, but on the rupee term, it is remaining constant, mainly because of the issue related to FX, Forex. Because last year the fixed costs were translated at 70 rupees. This year the fixed costs are getting translated at close to 74, 75.
That's right.
Okay. And can you quantify the UK any one-off in EBITDA level?
UK, they explained, I think, at the beginning of the call in terms of 3-4 factors. One was the impact of the flood. 2 is that we had a deferred tax asset write-off in the quarter. And the 3rd was the refinancing cost taken in Q4. These 3 elements are more like
deferred tax is part of EBITDA?
Oh, sorry. So that's more on PAT element here. So EBITDA is more because of the flood impact and because of the refinancing costs.
So how much the fund amount will be?
Can't really tell you offhand now. We'll come back to you on this.
Okay. And last question, in capex you have shown in FY21 1242 crore. Can you give the breakup of that?
You're saying in the console breakup of the capex spend,
right? 1242 crore breakup.
We'll come back on that because offhand we don't know the numbers.
Okay. And talking about the domestic US business volume decline, is it because of lockdown and any other the demand slowdown? The US domestic soda as YY has gone down. Is because of
for the full year?
Lockdown?
For the full year?
Yeah, I'm talking about the
I think, Zarir, you may want to explain what has really happened with one specific contract broadly, but otherwise there's no decline, isn't it?
Yeah. I don't think there's a decline. I think, as Mukund mentioned, demand has completely come back, which means all customers across application segments are operating at normal rates. What has happened here is one of our large customers, domestic, that has a plant both in North America and across the world, moved some of their volumes from domestic to international, and in order to support them, we've moved some of those volumes also into the export market. Yeah. So that's what's happened there.
Thank you so much.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants, we would request you to please limit your question to 2 at a time. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Karthik Jonsa from NVS Brokerage. Please go ahead.
Hello, sir.
Yeah.
Yeah, sir, I have a question. So I was just going through your presentation, and the PAT margins about a year back they were in the range of 8 to 9%. Just wanted to check. You just explained a couple of reasons, but when do you perceive, quarter-on-quarter basis, you'll achieve this kind of a margin going forward? And what is your basically take for next 1 or 2 years on the top line growth going forward?
So on the top line growth, as the capacities we are putting in India, mainly in Mithapur and in Raleigh, and the full utilization of the units in South happen, our own estimation of the growth is close to, I'm going to give a range, at least 50 to 70% growth will be there on the top line, and that will happen. Now, in terms of, and that's on the consolidated basis, which means it includes almost, let's say, nil growth elsewhere, but mainly in all the Indian units, including Raleigh, our subsidiary. In terms of 8 to 9% margin, if you look at the numbers, we've had a fall of about 5%, dip in contribution itself, which is largely led by the price erosion which we've had, and shortfall in certain volume numbers in the H1 of the year, which has led to this. And I think volumes are back, and the prices, as Zarir has already explained, will continue to improve quarter on quarter, and we expect by Q4, when we negotiate next year contracts, and assuming the pandemic stays under control globally, and we get back to those levels, we should be inching closer to that 8-9% margin which you said.
I believe some gentlemen initially had asked you on the EV front, so just wanted to understand, are we still progressing, because I was just cut off for a second in between. So are we still progressing on the EV front, or there has been some deviation in the plans?
In terms of the progress itself, it stands at the same level. We are reviewing it. There is no specific decision taken, and our efforts in the R&D continue, but beyond that, we are just in a review mode.
Okay. And sir, the 50 to 70% growth in the top line, what we just mentioned right now, it will be over a period of next 2 to 3 years, if I'm not wrong, right?
Yeah, we could probably say closer to 25, 26. That's
okay, perfect.
Perfect.
Perfect. Thank you so much. Thank you so much, and best of luck, sir. Thank you so much.
Thank you. The next question is from the line of S. Ramesh from Nirmal Bang. Please go ahead.
Good morning and thank you very much. The first thing that one would like to understand is if you can quantify what is the kind of volume growth you can expect in FY22 and the average improvement in prices one can expect taking all the geographies for the FY22, that will be helpful.
Gary, you want to?
Yeah, I think in terms of volume growth, the way we see it today, excuse me, if you look at our various geographies, I think we should all be back to normal operating rates there, which means that volume will go back to historical levels as we progress into the year. In terms of pricing, as I mentioned to you, we are seeing price improvements in most of the export markets, but there we are constrained by contractual commitments. As they come up for renegotiation, we'll see a recovery in prices there as well. In the case of US domestic, those are typically annual contracts, which means that we are unlikely to see any price declines in those markets. And as we come into the end of the calendar year and into next year, we should see either stable or an increased pricing in some of those markets as well.
So in your assessment,
Mukund, go ahead.
To highlight, the full impact of the recovery of price would be visible by Q4, but sequentially it should be improving as contracts come for renewal.
Yeah, so just to follow up on that, so if you look at FY23, can we expect the average volumes of around 3.6 to 3.7 million tons, which have had in the last 5 years, assuming normal consumption growth in all the end-use sectors? Or will it be, more like in FY24 that you see that kind of peak volumes?
No, I believe it will probably happen in the next financial year, for sure.
Okay. And just
one
last thought, in terms of the US and UK operations, they have had this one-off items, kind of impacting the numbers. So how long do you think, it will take for the normalized, revenue growth and margins in the US and UK operations, assuming normal energy prices and your costs are, absorbed on normal volumes?
In US, you should see this during the year, so there is no need to change. As far as UK is concerned, I think even as the salt volumes pick up because the hospitality sector opens up, there also the margins will move to normal levels. So you would see this shift happening during the year. And we've taken all precautions with this unseasonal floods. We are now saying extreme climate events are going to be the new normal, so we need to prepare for it. So whatever precautions are needed, we will work through the year to make sure they are put in place well in advance.
Thank you very much. That's helpful, and wish you all the best.
Thank you. The next question is from the line of Madhav Marza from Fidelity Investments. Please go ahead.
Hi, good afternoon. Thank you so much for your time. I just wanted to understand the capex spends that we have lined up for FY22, and if there's any sort of broad thought process for FY23. On what projects are we spending the growth capex? If you could just help break it down a little bit, that would be really helpful.
Actually, we had shared this in the, I think, previous presentation, so we are happy to share that again. But broadly, let me say this capex spend of spread over the next 3 years, and it is going to be in Rallis close to the balance left is about, I think, 500 odd crores, but it's going to be spent on mainly the manufacture of technicals and formulation units in the Dahej. And in terms of the Tata Chemicals itself is concerned, the capex spend is largely concentrated in Mithapur, and large part of it is for expanding salt capacity from 1 million ton to 1.5. We are already at 1.2, and I think we'll inch towards 1.5 by adding another 300,000 tons of capacity there, sequentially over next year. And the soda ash capacity would go up by another 200,000 ton broadly. Part of that 200,000 ton expansion will reflect itself as a bicarbonate output, because that also would go up, and part of it would reflect as pure soda ash. So these are the three broad product lines of investment as of now, which have been cleared and approved, which are under execution.
And just as a follow-up, what about, I think in the 2Q FY21 con call, we had sounded out growing capacity for the XDS and the nutraceutical business in a fairly aggressive way. So will that happen in the next couple of years, or it's sort of more 2-3 years out once these existing capacities ramp up?
No, I think that's also on track, and I think, sorry if I missed that out. The first priority is for us to shift the product mix in silica, and after that, the next phase of investment to move that capacity from 10,000 to 50,000 is what we had said at that point of time. We will come back to you with specific plan, but it's pretty much on the radar, and it's not off the radar. And second, in terms of the Nellore capacity to move from 5,000 to 10,000 is also on the radar. But right now, the utilization is what we want to exit. We want to exit this current year with a high utilization of 75-80% utilization with the current unit, so that we can deliver on the bottom line. So our approach is that the plan we had set out is on track. We want to make sure that this year we deliver a steady outcome in terms of EBITDA margins, so that when we expand, we build on that margin as the new streams come on stream.
And the 75% exit utilization we're looking at for both XDS and nutraceutical by end of FY22. So that's the sort of target by.
So there's a difference. The silica business actually has a pretty high utilization even now. They have to shift the product mix from food grade to rubber and tire grade, which is more higher specification. So it's a grade and mix issue. As far as Nellore is concerned, it's a capacity issue, which they have exited close to, I think, about 40-45%. They need to up the utilization close to 70-75%.
All right. And my last question is basically on the battery chemicals bit. A lot of questions have been asked already, but I just wanted to understand basically what will be the trigger for us to sort of commit capex for this project. Is it basically looking at India's electric vehicle industry as a whole picking up? Is that what we are basically looking at before we start committing capex here?
There's an all-round review going on. I think we are seized of it, and whatever the outcome is, once it is done, we will come back to its specifics. As of now, I think what we are really focused is making sure that the review is comprehensive.
Okay. And does the government PLI program also sort of help us in this direction? Does that sort of benefit any capex in this space?
Sorry?
The government PLI program, does that have any allocation for the kind of investments that we might do in this space in the future?
No, I think in terms of the PLI program across all categories, we are in active discussions. We have given our suggestions to government, and our view is that these are welcome. And there are some suggestions we have given in terms of how each one should operate, and the government is also actively taking them on board. If it makes financial sense for us, we will go through the route of the PLI scheme. In other cases, we may just do the investment in any case because the market needs it.
Thank you. I would request Mr. Malda to rejoin the queue. The next question is from the line of Harsh Bhatia from MK Global. Please go ahead. Harsh Bhatia from MK Global, your line is in the talk mode. You may go ahead with your question.
Yeah, hi. Thanks for the opportunity. I just have two simple questions. Considering that Church & Dwight in Owen, Illinois, these are key customers in the North American market, Owen, Illinois, for example, is ramping up its recycling efforts in the glass segment. That's what we can see from their commentary. How does the management in obviously next 2 to 3 years look at this recycling impact on the soda ash demand? So that is my first question. Thanks.
Members of the management, can you please confirm?
Hello, I lost the line. Can someone repeat it again?
Mr. Bhatia, can you please repeat your question?
Yeah, sure. So my question pertains to one of the key customers, considering that Owen, Illinois is one of the key customers for Tata Chemicals in North America, and they have been ramping up their sustainability efforts through recycling of glass. And just on a broader basis, in next 2 to 3 years, how do we see this recycling effort in glass segment impact the soda ash demand? If it is negative, if it is net positive. So just the management thoughts.
Okay, thank you. I think Zari will also expand on this. I think this focus on sustainability is extremely critical. As you know, Tata Chemicals also has signed up and our SBTi targets have been approved. And our team is actively working to make sure our capital plan henceforth is aligned to moving in the direction of the science-based targets. And we are also working out a plan what we need to do beyond that target, which has been set for 2030. And I think likewise, all our customers are moving in the same direction. And it's very important to be part of this network of companies which are committed to climate change and climate change efforts. One piece of that is, of course, the recycling business. In every area, people will be moving towards recycling. And effectively, with recycling, the need for fresh soda ash would come down marginally. But as you know, globally the demand for soda ash continues to increase, and with that, with the movement from away from plastics to glass, which is a normal trend as part of the sustainability, we believe it is right for container glass manufacturers to the extent they can move towards recycled glass. It is positive. But also, just wanted to highlight the recycled glass usually cannot be the clear glass. Clear glass is usually made from virgin material. Recycled glass is used mainly for colored glass production, and I think there's a limitation in terms of the demand that kind of a glass would have. So both will coexist. And our view is that we welcome this move by our customers and we would support them to the extent they can. And I think this will also make sure that need for virgin material overall, even as growth of demand happens, it is supported well with the current supply base already established. Broadly, overall, if you look at it, in container shift from plastic to glass is going to be a bigger shift than this recycling going out and creating a downshift. Zari, you want to add anything?
No, I think Mukund, that's exactly it. And actually, if you look at OI, we are actually working along with them on some of these initiatives. And there are two things happening in OI. One is exactly what you picked up, which is, the move towards greater recycling. But at the same time, they're also expanding capacity for container glass across the globe, right? And that is really being driven by what Mukundan spoke about, which is the move from plastics to glass. And it's not just OI. I think we are seeing all of our container glass people doing that.
That's really helpful. Moving on to the soda ash royalty reduction the government has in North America, specifically for Wyoming, has slashed the rates from 6 to 2% for the next 10 years. Going back to the same quantitative move in 2012, the government had moved from 2 to 6% in the reverse direction. At that point, Mukunda sir had commented that the impact would be in the range of $7 to $10. So obviously this time it might be slightly different. If you could share your views, how should we look at the soda ash royalty reduction in the current terms? And over the next 10 years, what is the quantitative impact on a per ton basis? Thanks.
Zari?
Yeah, I think once again, two things that determine this is the mining plan of various producers, right? So how much do you mine out of government leased areas and how much from private? And obviously the team in North America is trying to optimize that. I think the numbers should land somewhere close to what you mentioned, perhaps a little on the lower side, but we'll get greater clarity as we work through our fresh mining plans.
Yeah, I think just to clarify, in US, the state, there's an alternate between federal lease and state lease, and I think the alternate plots of 1 square mile. So you really need to work through your mining plan to arrive at the exact number, but it broadly is going to be in the same range. We'll get back to you next time on exact number once the team has completed its review of its own mining plan.
Thanks. Just one last question from my end. Are we looking to broaden our portfolio in the specialty chemicals business, looking at downstream derivatives in the benzene chain or toluene chain, something like that? Thanks.
Yeah. So I think the team in Mitapur is looking at what beyond the plan we have already got the approval from board, and I think that includes the current plan. It certainly includes expansion of fluor caustic, but also I think the chlorine and bromine derivative is one area the team is focused on, but we'll come back to its specifics. I don't want to make any comment, but to tell you directionally, the focus is there in terms of where to take Mitapur so that site becomes more and more a specialty site. As far as the nutrition portfolio is concerned, the beyond salt, I think our approach is to build on the fermentation platform. I think it's a pretty sound platform, and the current unit in Nellore can go at least 4 or 5 times the current capacity, and there are exciting products which we believe are there. Once we prove the current unit delivers on EBITDA positive turnover, and after that we'll move forward with further investment. In terms of the performance materials concerned, I think silica is a business we believe is extremely versatile with wide application, and we would continue to push ahead building on what we have already in our portfolio. So all the 3 elements, which is our inorganic chemicals, which is the halogen chain, the silica chain, on the performance material side, on the nutrition side, the fermentation platform, both these afford multiple product portfolio, and I think these are the areas we're going to continue to focus and expand. Right now, I think we are committed to delivering on the approved plan, and as that plan comes to close, which means most investments are on the ground, we will come with the next phase of plan beyond that.
Yes, thank you, and wishing you the best.
Thank you. The next question is from the line of Tejas Sheth from Nippon India AMC. Please go ahead.
Yeah, good afternoon. The US annual contract which was signed for this year, what would be the price difference versus last year?
Go ahead.
Yeah, I think US domestic contracts typically tend to be 1 year or longer. So there are also multi-year contracts.
Okay.
So if you look at pricing between last year and this year, I would imagine that while there is some compression, it's not as large as the compression that we've seen in the export markets, which again, as we mentioned, is recovering.
Okay. And in US operation, how much of the volume would be contractual and how much would be in the spot?
Oh, US volumes are almost all contractual. There's very little spot in US.
Okay,
US domestic.
Okay.
US domestic. Which is why I said the pricing, somebody else had asked earlier, the pricing for this year is set for US domestic.
Okay. And what would be the budgeted capex for FY22?
Do you have the figure ready?
Not ready right now, because I have only last year's numbers, which we have, but next year's numbers we don't keep it. And I think we don't share the numbers also. If you look at the whole thing, we'll come back to you later.
Okay. Just last bit.
Last year's numbers. There was a question earlier on the capex spend. I don't know what the question. I can answer that in case you wanted to. That will also help you to build the model. So we had 1250 crores capex last year on the whole. 550 was Tata Chemicals for standalone company. 250 is US. 270 is Europe. 160 is Rallis. And 15 is Kenya. 1250 is the overall number for last year. So next year's number you can work out with your assumptions.
Sure, sure. Thank you for this. Just on the investments towards nutraceutical, Mukund also highlighted that it can be a big opportunity of 5x. When can we see a larger investment going in that space, considering that we'll be looking at exiting this year at a very high utilization?
Yeah, I think, as I mentioned, towards the end of this year we'll come back, because I think we would have had surety of all the pieces falling in place and then going into the next phase of investment in that. But at the same time, if you look at the nutrition portfolio, the salt also remains equally attractive as the other one. So there is headroom to move both the needle on both fronts.
Okay. Thank you, Pat.
Thank you. The next question is from the line of Abhijit Akela from IIFL Securities. Please go ahead.
Yeah, good afternoon. Thank you so much for taking my questions. Just a couple. First is Mr. Mukundan just mentioned that some time back about a 15 to 17% consol revenue growth target for the next few years. So just wanted to make sure I heard the projection correctly, and also if you could drill down a little bit in terms of what the key building blocks of this growth rate will be across business divisions.
Sorry, I think it was not growth rate. It was, I said by 25 odd, our number should be inching close to 50% to 70% higher than where we are, broadly in that range for you to plan on the basis of investments. And the breakdown is growth in, let me start with our subsidiaries. There is growth in the Pitapur unit, mainly in salt. There is also growth in soda ash. There is also growth in the chlor-caustic chain, all these three put together, in addition to growth in the nutraceutical business based out of Nellore. But exact split, we could start sharing what these buckets continue in terms of revenue. Maybe by next quarter we could share broadly capital spend as well as the revenue split, what we anticipate in with broad ranges established.
Right. Thank you for that. The second thing I just had was on the US business. North America, is it possible to just roughly break out the geographical breakdown of exports from there? How much goes to Asia, how much goes to Latin America and other regions, and how you're seeing the spot prices behave across these regions.
Sorry, can you repeat it? I lost you in between.
Yeah, the U.S. exports, if it's possible to just give us a rough breakdown of geography-wise exports, just roughly, how much goes to Asia, how much goes to Latin America and other regions, and how are spot prices behaving across each of these regions?
Sorry, you want to go ahead? I think it's broadly 50-50, but I think go ahead.
Yeah. So most of our exports, as you're aware, is through ANZAC. So while we may not have exact numbers because we do maintain a wall, I think it's approximately the two main markets are obviously Latin America and Southeast Asia, split roughly equally between the two. And as we mentioned, we've seen prices in Southeast Asia moving up, spot prices, in some cases as high as $25. In Latin America also, we're seeing a movement upwards. It's not to the same extent, but it's certainly in the same direction.
And in LATAM as well, is the pricing on a quarterly basis, sir?
No, LATAM tends to be slightly longer in terms of contracts, so it's half yearly and annual.
Got it. And just one last thing, if I may just squeeze in. On the gas cost, is there a like a pass-through clause that you have, some kind of fuel price surcharge clause that you can invoke in case the gas cost goes up, or is that not an option anymore? And second, on the mining royalty front, the royalty rate reduction, will it actually, do you expect it to boost your EBITDA margin in the US?
So on the royalty, I think it will boost the EBITDA because it is part of the cost structure. Secondly, on this gas cost, there is a clause on energy, certainly in all contracts. But I think we have not invoked anything with our customers as of now.
Yeah, the two. One is obviously we've not invoked it. The second, while it exists in the contracts, there is a certain minimum period for which these prices need to persist.
Got it. Thank you so much. Wish you all the best.
Thank you. And I just wanted to address the previous question. The capex, our anticipation for the current year is about the same where we landed the current. Next year is going to be about the same where we landed the current year, as Nandu has explained. But there's an increased bias of capex towards within India rather than overseas. So there's a higher proportion of this will be in India, both between Rallis and Tata Chemicals India.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to the management for closing comments.
Thank you all, and I think with the current situation of COVID, I think we all have to stay safe and protect ourselves and protect our families, and we are extremely hopeful that this current surge will start to subside in a couple of months. In some regions, it will start to subside in a month, and it will take probably a couple of months for us to get complete control over it, and that's the way we are planning the business. Hopefully, post this wave, we would have learned the lessons to deal with this pandemic in a more effective manner so that it allows both life and livelihoods to continue. In terms of our business plan, our strategy and business continues to be the same. Our pillars of performance, material, nutrition, and agri-science are the three broad pillars in which our investments are being done. A large part of this investment is focused in India and for India as well as for the world market. And as we come out of the pandemic, as prices pick up, I think we will be back to our normal run rate, both in terms of return ratios as well as in terms of our margins, contribution, and profitability margin. This quarter has been difficult, but we are looking forward to the coming year with great optimism. On the back of the demand of soda ash coming fully back on stream and also the pricing power coming back, and sequentially we'll see this flowing into our financials going forward into next year. Thank you, and thank you for your support and all the good guidance. Thank you.
Thank you. On behalf of Tata Chemicals Limited, that concludes the conference call. Thank you for joining us, and you may now disconnect your lines.